thank you everyone for joining us. Look, we thought about this about probably about a month or so ago, given just the madness that's going on in the world, right? So you obviously the extreme volatility that's going on in financial markets, the amount of noise that we have to navigate through as retail traders or professional traders. There's obviously a belief that there's more to come. People are talking about bubbles, health crisis, economic crisis. There's everything going on into this one melting pot. So we thought it's a great idea to get some people who are authorities on the matter, people who are actually dealing with money themselves, either their own money and trading professionally or managing clients' money, and sort of pit people off in a sense of having some interesting debates about things that are moving at the moment and current debates that are very topical, I guess, more than anything else. So we've got Adam Webb and Nicholas Bovell on this one here. The great, both macro guys, both can talk about pretty much anything and everything. And it's a really great time for these guys to kick off, because they're both very close to my heart in terms of what they can speak about. And we're going to cover quite a lot of ground, hopefully, both from a trading perspective and how they've dealt with the situation, how they deal with things going forward, but also what they're looking for in markets as well. So without further ado, I'll probably start by introducing the two guests today. So on the left, we've got Adam Webb, aka Trader Skew, and we've got Nicholas Bovell as well. Adam runs Macro Hedge. He has done since 2019. He's ex-Goldman Sachs guy, big in the options world. So there's a lot of people here who probably won't be particularly au fait with the Greeks or what's going on in terms of delta hedging or gamma hedging and all those factors. And we probably won't go into huge amounts of deep dives into the options world, but it gives a different perspective. He's also big into the oil markets as well. He trades rates to an extent, and he trades spot FX as well. So he's perfectly positioned just to talk about what's going on. And we've got Nicholas as well. So Nicholas has been running the Bovell macro fund since 2019 as well. He trades his own money, also trades money for clients as well.
Chris, sorry to interrupt. The other organizer crackling. So just me and Nick can hear it. I'm sure everyone else can. He needs to mute. It's the other guy. That's it. You go for it now, Chris.
Thank you. Yeah. So both guys. And I think it's really important here because both guys manage their own money. They manage money for clients as well, and that's a really interesting concept. So I'll start with you, Adam. Just give us a little bit about the background about Macro Hedged and what you guys do over there.
Yeah, sure. So I've been in the market since late 90s. I'm showing my age. And after coming out of an investment bank world, I kind of set up myself to market make into the crude space. I've been doing that for many years now. And I guess over the course of that period of time, over the last kind of 15, 20 years, I've either accumulated and managed my own wealth or been looking at taking money, managing money over a period of time. I think for me, kind of where I am now, I'm 43 years old, the thought of managing money, as we've talked about before, for me is not high on my list. But certainly my business partner, we've set up a separate fund. He's running that. It's going really well. And kind of how did Macro Hedge come about? Well, really, I think there's just a frustration of so much kind of poor education, people not understanding kind of the wider space of the market. So we just kind of threw everything out there. She said, you know what, we could, here's some realities to what we're doing. I threw some money at the trades, and what we did, we've tracked everything. We've got an independent broker out of Chicago that tracks things. It really, the Macro Hedge, whilst the Macro Hedge has got a lot of awareness, and there's a lot of retail money that kind of see what we're doing, kind of the baseline of our business is much more akin to the interbank space, the OTC market making. So we kind of bridge both worlds. So, but it's really funny is that you shift more dollar in a institutional space, no one hears about it. When you kind of talk about one item in the retail space, 100,000 people want to know what you did. So that's been a weird thing for me. So that's me.
Great stuff. I'll just before we go on to you, Nick, I just want to quickly read the disclaimer. I put up just a couple of seconds ago, but just for everyone's benefit there, Any information you hear today is going to be general in nature. Please obviously don't consider this to be personal advice in any shape or form. These are all the own thoughts of myself and the guests, and obviously they don't represent a view of Pepperstone. So if you take a quick second to have a look at that, that'd be awesome. Nick, we'll go into you. I pulled this off Bloomberg. I can actually get the details and the performance of your fund since inception. I think over the last three months, you're up about 13%, and you can see over the year you're up about 113%. So talk to me a little bit about your macro fund.
Yeah, well, we set it up towards the end of 2017. I've been trading basically since 2009. Got a bit of education from some professional traders along the way, and then obviously having to navigate all the rubbish that's out there in the education space during that period as well. And then, things start to come together around sort of 2014, 15. I started managing some capital for some friends and family and performed pretty well. So I thought I may as well bite the bullet and set up a regulated entity. So yeah, we set that up with a very small amount of money at the end of 2017, and then we didn't really open up until open up to outside investors until sort of 2019 is when we set up a USD share class for the wider market, basically, because before that we just had the Aussie share class, which is just for my sort of local investors. So yeah, the fund's done well in the last 12 months. Basically, a 12-month rolling is in excess of 100% after fees. So it's been a good run. But like what you don't see in that performance is we still had plenty of bad trades, plenty of devastating days. You just gotta get back on the horse and make it back. So yeah, that's where we're going with that.
Cool. Right. What I want to do is I want to talk a little bit about your process and what you do. What's your DNA at Macro Hedged and the Bovell Macro Fund as well. So we talk about, for retail traders and people getting into the market, this sense that you have to have a process, you have to have a framework. Right from the start of getting to the desk, getting your mind in the right place, looking at the charts, looking at the fundamentals, getting a feel of the market, to executing the trade, looking at how you manage the risk around that, how much you assess risk, getting the correct position sizing, entering the trade, going through the whole thing right through to the end where you crystallize the trade, and you might go back and document your trades and try and understand what went right and what went wrong, the continuous improvement side of things. So I'm really interested, because when we start talking about markets, is adopting your framework and your process. Nick, I'll start with you. What's at the fund, when you're going out and trading and taking a trade, what's the process by which you follow? What's your framework?
Well, I mean, you start with the bird's eye view. You've got to always understand that there's different drivers of markets at any given time. Back when I was coming up, learning to trade, it was all about central bank monetary policy. That was the main driver of FX trades. And you look at that now, that's basically irrelevant this time, because at this current juncture, everyone's basically near zero. So, first and foremost, understanding the bigger picture. Last couple of years, we've had Brexit driving markets, we've had the China trade war driving markets for a period of time. In 2018, it was NAFTA. Obviously now it's the exogenous risk factor of the pandemic. So, as a base, always appreciating that markets are dynamic, and maybe next month the market's going to be responding to something else. But, then zooming in, I have two audio sports that run 24 hours a day, 5 days a week. So basically, I'm always sort of aware of any major news. And then I just try and stick to the major themes and the obvious trades. I don't try and be a detective and sort of find some obscure trade. I think the best trades are the obvious trades, really.
And to you, Adam, I mean, talk to me about. I know you deal in a lot of optionality and other factors, but go through the framework, a very high level framework by which you guys believe in.
I think so. First thing's kind of the 100,000-foot view. Like, what is it you're trying to do? So, do you believe if the objective is that you think oil's going back up and equities might underperform. Then you look at what the time frame is that going to happen in, and then we have what we call the fuck frame, which is basically the opposite of the time frame, because you're going to have, say, 3 months to do that. At what point you absolutely got this wrong? Are you wrong after a month and you've got no way back? Are you wrong after 2 months? So, and then what's the cost of getting involved in that? And more importantly, when it comes to options, is where am I getting paid from, and who's paying me to be in the trade? So can I get away with this being cost-free? So I can get in the trade for being paid for a few ticks. Time goes on. We look at all of those kind of set things in a stage of our process. Then each one of those we iterate. Kind of, I mean, Ryan's on later, and he'll Hugh and I probably argue for hours and hours each day over what strikes to use, what the process we use. You're going to be absolutely screwed if we go in at that particular time frame. We should be looking at 6 months. Why are we looking at 4 months? Constantly having someone to kind of constantly tell you that you're wrong before you even go to actually start thinking about putting the trade on. I think that's what a lot of people that kind of, they might hit a few buttons and press things and just be off and running. If you are going to have, Nick said earlier, you're going to get ironed out on loads of trades. The key thing is winning at the end of the day. Our win rate is not great, but when we win, it's huge.
Yeah,
and we're okay beating up.
Well, I think that's just such a key point. When people start trading, it's all about the win-loss ratio. You want to be going to the guy in the pub and say, I'm getting 80% of my trades right. And I think there's this idea that you can never go broke taking a profit. It's probably one of the most misleading situations. I think most of the professional guys that I speak to, it's really all about what risk-reward ratio you're looking at when you're going in the trade. And if you're basically getting to, let's say you hit your profit targets, or if you trade with profit targets, but let's say you're going with a 2R, you can afford effectively to get 33% of your trades right and still make money on a consistent basis. So I think that idea of risk reward is absolutely key. I want to sort of set back on something that let's take it back. Let's paint the picture, because I think Adam, you're a Vol guy, and Nick, you've been all over this as well. But I think let's take a step back to this chart that I've put up Bloomberg here. As we came into February, and I've got some volatility measures, implied volatility measures, which we've got the VIX, the white line here, we've got the implied volatility index of the high yield ETF, and then oil as well, which is the purple line. And then you can see the S&P, which cracked on the 19th of February, the oil price, which sort of, it probably doesn't show it too well, just how big, obviously you probably need to change the dynamics on that one. But I think what was really interesting is on the 19th of February, when we've been running this, the market had been running an incredibly long-term short volatility trade for years and years and years. The pension funds, the mutual funds, everyone had been incentivized to go for yield enhancements. They were long stocks. They were basically selling calls above the market, buying deep out the money puts. I think collar strategy, isn't it? I think, Adam, they call that. But and then of course what we saw was just this wave of volatility positions just giving way. And I think everyone who's probably in this room remembers this move in the S&P. What we got 35% in 24 trading sessions. Even in GFC, we never saw anything like that, because volatility was at the heart of it. I think everyone got schooled in the art of understanding volatility. And then of course on the 9th of March, we saw the Saudis coming out and cutting oil prices down to those by about $7 a barrel to the US, and obviously we started talking about price wars, and that exacerbated the problem. So Nick, I'll probably start with you here. I mean, during that period, it was absolute pandemonium. And one of the key points of any trading process framework is understanding how price moves and range dictates your position sizing, right? So, how did you guys deal with that changing volatility, in terms of predicting and processing your position sizing around that?
Yeah, well, before that section of volatility kicked off, that period of time, I always use the average daily range I've been using over the last 12 months as a look back period to give myself basically a guide on how big each position should be for each instrument. But because the volatility blew out so quickly, I quickly changed that down to basically at one period of time, it was just 6 weeks. Because if you're using a 12-month average daily range to position size, then it's irrelevant when you've got such a big aberration in volatility. So yeah, we squeezed that look back period up. So then the position size is obviously much smaller with the larger average daily range. And the reason I like to use that system, I know that using implied vol is a great way to sort of see what's coming up as well. But the good thing about using the average daily range is you can have everything preset on every single instrument, without looking at the options market. And it's more of a guide than like a fixed rule. So it just means that you're going to be more consistent with your trade size, basically across various instruments.
This idea, when you get a lot of educators who come out and say to people, you've got to have 1% of your portfolio on each trade or 2%. Nonsense in your eyes? I mean, obviously you adjust for the volatility and the move in the market, right?
Yeah, definitely. I think that's one of the bad pieces of advice that I hear from pretend trader educators more than anything else is they say, if you've got $10,000 in your account, then use 0.1 lots on every trade. But the problem with that is you got different base currencies in different instruments, and you got different average daily range or different volatilities in different instruments. So you end up having completely inconsistent trade size, and you could have 2 wins and then 1 loss, and you're still in the negative because you're not consistent with your underlying trade size. And only someone who trades actually for a living, gets that. There's a lot of bad information out there.
What about you, Adam? I mean, obviously volatility is key to everything you do, isn't it? I mean, it's central to the options world, which is based on maths and everything's quantifiable, I suppose. But this idea of changing the position size based on movement in the market. How what's your advice around that? And how did you adapt through? Going back to this point here, how did you guys adapt to obviously the volatility spike that we saw there?
Yeah, I think so. When you're trading in an option, you're to break yourself away from the underlying asset or the movement of the underlying asset, you need to have a pure volatility position. You've got to delta hedge the entity. So if you've got, I don't know, to use an example of crude, it's at $40 and the out of the money is at $40 as well. So that means a $40 strike put is 50 delta. Okay. So that means for every 10 you do, you've got to hedge 5 to be delta neutral, right? So that's kind of the bedrock that the options market has been on since the Black-Scholes Merton model came about. And one of the problems that was happening in this vol spike, especially when you see it there in April for crude, the purple line spiking, that purple line nowhere near represents reality because the CBOE that run the VIX index lost the ability to track it. It actually went way higher. But what was happening is people were so panicked that they were ignoring any form of delta to an option. So that was problem number one. So crude was trading, say, $25, and people were buying a $15 a put option and pretending it was a delta of 1. So they were buying it as though it was still 100% in the money, and they were hedging to that basis alone. So which was just adding more and more fuel onto the fire of pushing and pushing and pushing. And coupled with that, the closer and closer we got to it for crude down to kind of sub $10. I don't know if you've got a chart with a skew wing, but as crude fell, the problem we have is that there was no more put wing to be lifted up for people to, because as a price falls, the demand for something that's getting nearer and nearer in the money, the volatility rises. And the wings have gone so high, all of the models that were issued, this is why kind of the likes of IB noted they had fundamental losses based on this, is because no one could actually get the models to work around that. I mean, they were just flatlining at 100%. They couldn't do anything. Fundamentally, the Whaley model, the Black-Scholes model, all of these things are all logarithmic models. You then couple in negative prices, and the whole system, just the whole energy market, is ground to this ridiculous halt. And I think that's, when volatility, when you get to those type of extremes, is, there's a saying that everything trades as one unit, and that's what was happening. I've never seen in my, I've been doing this since 94, 93, and I've never seen people buying a $15 put, 15 call, so 15 puts when the market's trading at $20 and treating them as a one, treating them as though they're in the money, because it was moving that fast down.
I just want to go and touch on something else, because a lot of people out there who are watching this wouldn't understand this dark art of delta hedging or gamma hedging. But and I'm not claiming to be an expert at all. And for a lot of people out there trading FX and indices, let's have a look at the daily ranges that we were seeing in the S&P in 2008. And I just want to use the S&P because I think the S&P is central. If you're trading FX, I'll show some charts when we start talking about currencies in a moment, just how influential this is. Adam talked about everything correlations going to 1. Well, if the S&P is going up, you're seeing risk FX moving in line with that. So everything's moving on with this risk on, risk off situation. But you could see the daily ranges during the DFC were getting obviously very high. This is the high to low. We didn't quite get to those levels in what we saw in the vol move in March, but you can see the rate of change on the downside was certainly more aggressive. And I don't want to sort of go into massive depth about the option side of things, but Adam, just the idea that when we saw prices moving through market makers gamma levels, and they're having to come out and having to gamma hedge and delta hedge and all these facts, and obviously selling the underlying. How important was that in the absolute that exasperated the move to the downside, and therefore how should people look at this going forward, and how important should it be for index traders going forward?
I mean, I think these two events, 2008. What happened this year? I mean, obviously it dwarfed Volmageddon back in 2018 Volmageddon, I think it was, wasn't it? And these are kind of mathematically redefining moments. And the term market maker or dealers gets lots and lots of attention. In reality, the people that were holding these short put plays were not market makers. We hedge pretty much immediately. I can just keep winding up the hedge. It would exacerbate it. The problem is the guys that are onboarding that risk. You mentioned it earlier, Chris, is when you said people are just selling those calls and getting long puts. And the guy who did that would be thinking to himself, oh my gosh, SPOOS has gone down 300 handles. I should be making a fortune. He goes back, revalues, sees vols up 20%, and the lurch in calls. In those short calls, he's still stuffing him. So now he's got to sell more underlines the whole time, and that was the problem. You could have actually sold calls. This was a crazy fact. You could have sold calls in crude at 35 strike calls and sold 3,200 calls in SPOOS. Crude be $10 lower and SPOOS was 600 handles lower, and you would have lost money. That's how high vol had got. It's just nuts to kind of comprehend that you're 600 handles on side in SPOOS, vol's so high you've still lost money.
SPOOS, for anyone who doesn't know, is S&P futures. Nick, in terms of some of the trades that you took out through the March period and to where we've gone now, obviously we've seen a big reversal in equities and risk markets more generally. If I go and bring up a chart of the Nasdaq, we can have a look at this huge move up here. How have you been playing this reversal that we've been seeing? I mean, there's been so much negativity about this trend that we've been seeing in a lot of risk assets. Coronavirus. We're going to see potential shutdowns again, are we? Or we're not sure. you know, it's going to be another economic downturn. You know, there's so much negative news, and yet we just continue to. You know, how have you guys been trading the market in the last couple of weeks here? You've been trading this from alongside. You've been doing different strategies. What's your call here?
Yeah, well, since sort of April, when the dust started to settle, I basically have been getting in and out of like what I call a recovery portfolio. I'm not in it now because I like to close ahead of the weekend sometimes, especially when things are so extended into the weekend, as we saw with the US indices into Friday close. But basically, well, I'll also caveat to say I haven't captured as much of the move as I would have liked, because I'm a little bit too skittish about, you know, there just being negative news coming through, like second waves and things like that. But long story short, long EMFX, like long peso and long the South African rand. Again, mainly against the US dollar. I think the US dollar is going to get crushed in the next, you know, 12 to 24 months, maybe even longer, if this recovery really takes hold, if we get a vaccine and all the things that the market's anticipating. Long G10 commodity FX as well. So my favorite there is actually the NOK. I don't know if you have the NOK up.
Well,
but,
yeah, we'll cover the FX side of things. I just want to sort of get a background. We can go into the sort of technicals and the background stuff in a second, but just to get a sense of, you know, how you've been sort of dealing with this flow and this move you've been seeing recently.
Yeah, I've definitely been on the long side of equities and commodities. I think you've got copper up there. I mean, copper's been, is that copper? No, you got NASDAQ up there. It basically looks the same as copper. It's just been relentless. And yeah, I mean, copper, nickel, even iron ore is starting to, you know, edge higher. And I think they're the really good assets to be in if we do get a vaccine, because you know, rates aren't going to move up for a while, I don't think.
I want to just touch on this shot, because this is the one that, you know, we can talk about bubbles and risk assets, right? And this is the one that gets thrown around on. This is the one that gets thrown around on social media all the time, right? So you've got, let me hone in, you know, the one that everyone talks about, the M2 money supply going up. You know, that's the last count we had 23%. Global money supply, you know, going ever higher, and you got the Fed's balance sheets. You know, purchasing, you know, various assets, US Treasuries, mortgage-backed securities. Now it's started to plateau. The balance sheet there has started to, you know, to roll over a bit. But, you know, I don't see that as a negative sign. I see that as a sign that other central banks are paying back a lot of the dollar swaps that they bought in March, or they picked up in March. So it's not necessarily a bad thing, but you can definitely see, you know, from a very simplistic perspective, that the market seems to be, you know, plateauing. Is this a distribution? But, you know, like obviously the word liquidity gets thrown around. I mean, how much do you think that this? I'll start with you, Adam. This concept of liquidity being the preeminent driver. I mean, you know, what's your view on that right now?
I think so. I would agree. I think what we're seeing is two things. I agree with Nick on long-term dollar weakness due to this supply of money. I think right now, where again we as traders and investors, we're so myopically looking, and we want everything to unfold so quickly. There's lots of time gaps that you can play. I think right now, liquidity, everywhere being awash with liquidity, does the BOE go negative as well? The ECB is also pumping liquidity. It's a ridiculous fact that the only real yield right now is Japan. That's scary. And what we will see over the next 4 to 5 months, certainly actually take it to the end of this year, is that liquidity story continuing to play out. I think when we start to see more macroeconomic factors within the wider economy, that liquidity will start to become a factor that's enables some stability. But the next year's story will be, you know, in America they use the term Main Street. They won't be able to stop the collapse of Main Street. They just won't. You know, this liquidity is still being consumed, I would say, a core money supply area, and a factor that I've always seen whenever I've kind of helped out any large institutions, they always use these major shocks in the economy as a means of improving productivity. and it will be continue to do that. You know, 2008 was a massive purge of human beings. 2020 will now be another purge of human beings out of corporations to a form of automation. Now, you know, do we then go and see growth stocks and value just even more dissipate apart from each other? Yes, it's possible. That I think also next year we will start to see the tax story come back, which will be very interesting, because especially here I can talk about in the UK is that a lot of large organisations are incentivized to hire a lot of people that they don't need. You know, example, any train station in the UK like Cafe Nero, Starbucks, they're given nearly free rent as long as they make sure they've got 5 people on the whole time. It's our government forcing a free version of a tax model. And I think all of these things will unwind, and this liquidity story will actually be something people will come to actually rely on, whereas at the moment it's being a bit front funded into easy asset.
Well, I think I'll just bring up this chart as well. I'll see if you can talk to this, Nick. I'm not sure if you know, how versed you are in bond markets, but for me, you know, the bond market is absolutely key right now. Absolutely essential to everything that's going on. So if you were to look at inflation expectations, they've started to move a little bit higher, and bond yields have stayed just very flat. We'll talk. I've got a really great chart I just want to bring up with you in a moment. But if you look at the move that we're seeing in real yield, so that's inflation adjusted bond yields, which is this red line, relative to the NASDAQ white line, and then you've got the gold price conveniently in a kind of goldy orangey color, and you can see that really, you know, that they're moving in the same direction. The correlation breaks down a little bit around here, but really since this sort of time, you know, they've all been working in unison. So you've got gold and equities all moving in line. And what's the common denominator between the two? It's the fact that inflation adjusted bonds are getting ever deeper negative. I've actually flipped this upside down. So, you know, the red line's actually getting more deeper negative. So the real return you're getting in the bond market is getting lower and lower and lower. So it's just driving growth at any, you know, people want growth at any cost. So people want the NASDAQ, you know, people want gold. And so for me, until we see a change in that bond market, and you know, yields actually moving up sharply, we're onwards and upwards. I think people, you know, dips are going to be shallow. I think we're going to continue to see higher levels through, and you've got to take a continued positive bias on this market. I mean, Nick, is this something that you look at in terms of the fixed income market, how that drives, you know, equities and other risk assets as well?
Yeah, I mainly look at yields and real yields in terms of if I have a position on in gold, obviously gold being basically, you know, because it's got no yield of its own, its value is its relative value to a treasury bond. So look, I don't really see how yields can go a lot more negative. If we get a vaccine in the next 6 to 12 months, then, you know, I think that eventually the economy comes back and consumer demand starts picking up again after we get a vaccine. It's getting disseminated to people, and then once you get that consumer demand and a little bit of inflation, then I think yields start to move up, and I think, you know, gold will be on a downward trajectory after that.
Wow, pretty cool. The man is calling the gold move lower.
But but I'm talking maybe it could happen any time in the next sort of 6 to 24 months.
Yeah, and I think that's the thing, is that Nick's probably right. Is we've got to see that we don't think we've seen the economic hardship hit, but as soon as that kind of bottoms out, very quickly the market will react to that. It's overreacted on the downside, you know, during February, March. You know, most of your friends on Facebook thought we were all nut jobs because we were saying we're about to go into lockdown, because we're seeing that the market's already down 35% and bounced back. They're now just saying, oh, should we start selling stocks? There's this timeline difference. So I agree with Nick there, is that you fast forward 12 months, and we might have the market will start to be looking at where's that yield pull. There's some interesting mid-curve activity going on in the STIRs at the moment, where people are starting to think, you know, when we bottom economically, if that's Q1 next year, what can we play in for September 21? So I think, yeah, it's hard to say these things, isn't it? You say gold's top, people think you said it for tomorrow morning.
Yeah, that's true. Yeah, time frame's always an interesting one. I just want to touch on this chart because I think this is really good. Well, this is a really interesting one. So we've got the 10-year Treasury. I mean, your Raoul Powell's talk about this, the cows come home, but this is when you talk about this idea of economic divergence, economies are in quite a dire strait. We're going to see obviously recessions around the world. We're seeing some signs of better data, but certainly, we've seen, if you look at the cyclical side of the S&P relative to defensive sectors, you can see that's obviously had a strong rebound. The copper gold ratio has had a nice move up. The copper's been outperforming gold, usually a sign of inflation expectations moving up, which we've seen in the break evens. I've gone out to the 5th month WTI contract.
You got a lot of respect for doing that. I was just thinking, most people stick first or second on that. So well done there.
I just wanted to go around the turn of the year, to, get rid of all the craziness that's going on in the front months. And you can see basically all of these markets have had a nice rebound. So they're telling you one thing, but the bond market is telling you something a lot more sinister. I know people love treasuries. People love treasuries because you can buy a treasury and you can pledge it as collateral, for repo and get short-term cash, and they've got other things and bits and pieces. But when we talk about divergence, this is the chart for me which continues to tell one thing: the copper gold market, stocks, longer term, medium term oil market, they're all telling us that we're seeing better signs ahead. One of these is right, one of them's wrong. How does this reconcile itself, Nicholas?
Well, yeah, I mean, it's a good question. I think that the base metals like copper and some of the other ones, just like nickel, just got hit so hard. They're just basically mean reverting a little bit before they start pricing in the actual recovery. I mean, you look at copper and it's basically back to where it was when the pandemic first started kicking off. So yeah, I mean, with rates where they are compared to where they were when the pandemic began, it's only natural that commodities and equities will continue to boom. But as for the bond market signaling the other way, I guess that's sort of a function of central banks as well, expectations for central banks.
I think I'd agree there, because I would explain that Treasury flattening is just where we are, whilst it's not official policy, yield curve control. YCC is happening, and that blue line now in that chart is kind of confirming what Nick's just saying. We're seeing that yield curve control playing out right now. Rather than this pandemic and the liquidity wash should have had the Fed go negative in reality of what the ECB's done, but you can't have the world's base currency and it would fundamentally break everything. So YCC is going through at the moment, and that's why I think we're seeing that flat line. Is we could see a very distorted 10-year for the next 6 to 9 months, and these other assets could continue to ramp, and that may make a lot of people in our space very rich, but it will come calling eventually.
Yeah, I want to talk. We talked about earlier about this idea of correlations in markets at the moment. I'll start with you, Nick, because you talked about the currency markets there. We've got S&P futures, this white line, and then you've got your. I've flipped them around just to show you can show the move. So you've got Aussie dollar, Kiwi dollar, NOK cable, and then CAD dollar. And you can see they're all sort of just moving around in this sort of risk on, risk off. They're moving in line with S&P futures. So if S&P futures are going up, you've got Aussie dollar, Kiwi dollar, and all those factors moving up a line as well. I mean, how much does this affect your judgment, Nick, when you're trading FX? Do you have like a side chart of S&P futures that you sort of keep an eye on and make your judgment call on what's going on with these risk currencies?
Oh yeah, 100%. I'm always trading I'm basically trading baskets these days. I'm never just like in the Aussie. If I want to do a pro risk trade, it will be Aussie, Kiwi, CAD, NOK, all together. We might have lost he's back. Yeah, so Yeah, look, I always have the equities up and you know, bond yields up and everything up before I'll take a trade on the FX market, because you've got to gauge that sentiment. And because we don't have a monetary policy trade going on right now in terms of an idiosyncratic currency or central bank where it's like, oh, we're going to sell or buy this because they're going hawkish or dovish. It's like that's out the window. So everything's trading on the macro theme of, you know, we're having a recovery. Then you want to be long commodities and long commodity FX. I think, you know, when air traffic starts coming back, whether that's in 6 months, whether that's in 2 years, I think the knock is going to absolutely boom.
What about you, Adam, on this? Yeah, how much do you look at the correlation analysis when you're thinking about these currencies? Is, you know, do you hold, you know, like the S&P as you know, as your independent variable, you know, something that very close to your heart? I mean, how does this risk on, risk off vibe, this high correlation environment affect the way that you're trading at the moment?
Well, we've had to pull out the usual kind of carry plays, you know, and like Nick just said, the macro flips have just died. You know, every central bank and every kind of G20 is now fighting on different footings. You know, you've got the export, euros kind of export driven, they actively want to drive that down. You know, how do you look at, you know, the Brazilian real? You know, it becomes a harvest currency. You start having to mix up things that you would never normally be aligning to your view, but throwing those in. I think, you know, for my personal assets, I'd reval everything back into dollars, and then I'll hedge my own sterling risk. You know, I think so you've got to put me. I live here in the UK. You're going to have to do that. If you're US based, you know, I think, you know, there's going to be some concerns over the next year. I think significant dollar weakness is coming, and we will start to see people, you know, aligning some interesting algorithms to how which they're monitoring their wealth over the next year or so. I mean, you know, Nick, your fund's in dollars, isn't it?
We've got USD and AUD. It's actually base currency is AUD, but we'll be switching that over at the end of this year to USD.
So do you?
Oh, go on, sorry.
I was just going to ask, are you of the cap size you've got, are you actively monitoring and managing your AUD asset? Because I mean, I do that for sterling. I'm always kind of hedging my natural long dollar position, sorry, short dollar position, long sterling position that you are with your own assets. Do you do the same thing? I mean, Aussie tumbles 5%. Do you want that squeeze that 5% out of the fund?
Yeah, so basically, because we've got the Aussie as a base currency, if the Aussie declines versus the USD, then that's actually good for our unhedged position. But I have to keep an extra vigilant monitor on rallies in Aussie versus the US dollar. And basically, what happened in April and May, and you know, even up to now, is really a situation where I've got to be long that pair, like at least at minimum to nullify the exposure. So at minimum as a hedge, but I don't have a permanent hedge on all the time. But that's what we're going to do. We're going to set up a euro class and a pound class. So we'll just have everything hedged all the time. So we win and lose, and because it does shave, it can shave like maybe, you know, 0.25% off the actual funds return when you have a big rally in the pair.
Yeah, I agree. I mean, the reason I asked you that was just, you know, cable's down from 1.3 to 1.25. It's not huge, but you know, you look at the course of the year, and that's a big dent that I've already taken in my dollar reval, just of personal assets, and then you roll that out across different funds. It's something that's just an ongoing thing. You're always having to manage. You've always got a position in your, and you know, we're doing this relative small fry to the big guns out there. You know, that's quite often these people they're turning hundreds of millions of just flipping out their own asset roll the whole time. Sorry, we digress.
I wanted to touch base on cable, and Nick, I know you delve and you swim in these fairly murky waters as well, but Yeah, we have had that move up there from the low 122s. The mood on the floor over in Blighty, what's the view there? Is cable, is this a short covering move that we've been seeing? Is there more upside up into say 127, 128? Obviously, we've got a lot of Brexit timelines coming up at the moment. So yeah, how do you play the pound at the moment, based on the fact that you don't necessarily are hardcore technical analysts, you're looking at other factors as well. How do you play cable at the moment? I'll start with you, Adam.
The good question. The question was, how do you play cable? So we'll absolutely say a pound against the dollar, and I'll just keep saying that because I genuinely think that we'll see the dollar outpaced weakening to anything else. Okay, so whilst I think the pound should get absolutely tranched, we might find it holds up against the dollar for the simple reason is the dollar is going to weaken. Now, the reality is, I've started only in the last 3 or 4 months looking at the pound on a basket, and it's getting ironed out everywhere. It's just holding up against the dollar for that dollar weakness. So I actually think this could be a really rangy, horrible trade for the next 6 to 12 months, even through the Brexit, is because of that. They're the two worsts of a bunch that are just going to be dancing with each other through a terrible range. So that's my take on it. If the US wasn't in so much trouble as well, I would be saying that the pound this would be sub 110 because the issues that the UK has got coming down the road are vast. But we are dancing with the two worst on the dance floor.
Yeah. And Nick, any views on cable right now?
Pretty much the same views. I don't touch the pound. Haven't touched the pound for ages. Since we smashed it pretty well when Brexit was kicking off. The resolution to Brexit, or one stage of the resolution to Brexit was kicking off in the end of 2019. We did, I think, 16% in December, which a lot of that was attributed to the pound. After that, I like to just take my money and run. It's nuts. There's too many variables. There's too much, just random news that can come in and sideswipe your trade. And it's basically trading like a risk currency, a commodity currency at the moment. It's very sensitive to risk. So, I prefer to play that risk through easier currencies.
I think that there was an article done by Bank of America that basically saying it's representative of a EM currency. And exactly. Liquidity is basically, I would say, there is a considerable decline in core resting liquidity that makes you look sometimes that you'll flick to the peso and think that looks deeper than the pound.
Yeah. Well, in five bowls, you can't compare those situations. I want to touch before we take a short period on questions. Yeah, I get this from clients all the time. Is what's, I know you probably, I'm not sure if you look more closely at the Brent market, Adam. But in terms of WTI, we've got this sort of the March gap that's come into place. We're banging on it so many times. I've obviously breaks through, then you start talking about trending markets. What's your sort of short to medium term view on the oil market? It's so important for inflation expectations, which we talked about, the influence that has on real yield. So, I think we can't dismiss the importance of the crude market. So, what's your short and medium term view on Brent or WTI, which is the chart I've got up here?
I think so. There's two things to answer the question really quickly. Is the reduction in capacity will cause some longer term lock-ins, and we've got issues with switching those back on. The number one factor in crude, even outpacing the demand story that's coming from coronavirus, is technology around extraction. No matter where the price of crude is, the extraction technology that's coming, it's phenomenal. You've got technology used out of Australia for pulling coal. Is now just being someone's done an offshoot, got a patent, and started using that in a well in Texas, and apparently they can go back to an existing fracked well and refrack it. So, and because that's already been capped and run, they can run at $12. So we've got that story, we've got the backdrop of that story, we've got the backdrop of the demand destruction. But that said, you know, long term, people are looking at this as an opportunity to push crude back higher. I hate looking at anything technically, but you know, that clearly looks like it's got to pop some stops. And I would say crude is not far away from moving back into backwardation, in which case we'll start to see that core demand coming back. The issue I have is as soon as we see any form of demand come back into the market, OPEC will be there for turning the taps back on, because we're not even pulling new crude out of the ground yet. We're still drawing down supplies. You know, it doesn't take a rocket scientist to go and look at off the coast of Africa. It looks like a flotilla of floating blacks. It's ridiculous. There's crude everywhere. Again, it sounds really dull for what we're in these crazy markets, but crude could easily be 30, 50 and sit around even kind of, I would say, back end of the year, 35, 45, and then over a year, 30, 50, easily, because of those merging factors. This event that we saw could be, we could see the aftershock dissemination of that wave still going on for another 12 months.
Nick, I've got a question which I think is really important to you. We're looking forward into the rest of the year, and of course, you know, one of the big talking points, which I think personally will come on to people's radars, probably mid-August, when we see the Democrat National Conference on I think the 17th and 20th, is the election. You know, we heard from Joe Biden this week about his policies potentially ending corporate capitalism, you know, taking on Amazon, Netflix. So we're looking ahead at the election. I mean, I can go through implied vols around that date. You know, how much is this going to start influencing you, Nick, and the fund, and how you sort of thinking about future trade ideas on the macro level? Because we have just been terrible prices of volatility, of risk around elections and political events. Yeah. So how much are you guys going to be looking at the election, and how much you sort of some of these big macro trades that you might put on? How much are you going to be thinking about that?
Yeah, well, I think it's too early to sort of you know, change your execution style at this stage, but it's definitely coming onto the radar. In terms of the portfolio that I'd like to have running up to sort of November, it's definitely something that's at risk of getting hit hard if we do see Biden continuing to lead the polls. Obviously, no one really has that much faith in polls these days, but you know, it's going to be more negative if he's leading the polls than if Trump's leading the polls. And we saw that last week when he came out. I think his speech was a lot more market unfriendly than a lot of people had expected. You know, whether it's raising taxes and, you know, basically trying to be a bit more sort of responsible with the whole fiscal side of things. I think that will definitely hit risk assets, but at the end of the day, he's not the central bank, so you know, it could just be like a, you know, buy the rumor, sell the fact type of thing, where the market just sees if he does win the election, the market sees that as a great buying opportunity to load back in, because you know, one man isn't going to be able to impact the central bank, the Fed's policy, basically.
Yeah. I've just brought up. Adam, I've just brought the term structure of the S&P of implied volatility, 100% moneyness, and you can see that naturally around the first debate, the second debate, and the third debate, vols are starting to move up, and you've got the election now. So obviously you want to look at where they were in recent history, but it does seem that the market is starting to price higher movement around the election. You know, how much, you know, what do you think about this idea about future volatility around the election, and what are you guys thinking about? You know, when do you think this is going to come onto your radar as potential trade opportunities?
Oh, it's already, you know, this has been on our radar. I mean, the S&P 500 debt contract was lit, obviously been lit over a half a year now. So this bubble in the term structure, in the vol structure, has been kind of well documented. It's in stirs in the bond market. It even got a bubble. The January crude as bubbles up as well a little bit. I think what we'll see is it's a little bit like kind of what happened here in the UK, where we get the kind of Corbyn on the left-hand side of the political divide, getting lots and lots of traction, and then suddenly the debates come, falls by the wayside, and it's steamrolls for the Conservatives. I think we're seeing a similar thing. You know, Biden's seeing a lot of love right now, but I think those debates he'll end up coming off worse. Pretty hard not to. And then all these will flatten out. Debate 1, debate 2, debate 3 will kind of flatten out back to Trump land, and then it's all on the election. But like, you know, as Nick just said, you can't really trust these polls. Agreed. You know, minus COVID, Americans have had a pretty good time under his policy. Whatever we all think of his craziness, I think the reality is could be a great opportunity to short some vol as we have more of the same afterwards.
We've got 4 minutes left until the end, keeping on schedule. But I guess the big one at the moment is, well, I've got a couple of questions around this. The involvement of retail in high-tech names. I'll give you an example. Citadel, there was a Bloomberg article over the weekend that Citadel are saying that they're seeing on any week, on big days, that retail are 25% of the volume. And we know that's because these zero commission brokers are effectively passing on the flow to these big entities, high frequency trading. You know, that's why you pay zero com, so they can do what they do with that. But you know, the retail now is a significant part of the market. Go back to April, and the top 5 brokers in the US were doing about 9.5 million trades, or 19 million trades a day. You put that on a $500 ticket, a small ticket clip, and you've effectively got, you know, in terms of turnover, about 20% of what the S&P does on a daily basis. It's, you know, it's crazy. And you look at what's happening in Tesla at the moment. You have a look at these high growth names. So I'll go back to you, Adam, here. You know, the retail trader is a big part of the market now. We can't go past that. It is in the options world now. I mean, you know, what lessons do you think they're going to learn along the way here?
The retail lessons learned, or the institutional providing the price to them? Who will learn the lesson? Which one do you mean, or both?
I'll go with retail. So I mean, how do you think this ends? I mean, are we in a bubble in high growth?
No, I think, look, you know, it's a really good question, and for me, we're seeing a change in the market space. I always try and what's happening is the term retail is become a bit of a catch-all for too many now, and I think we need to segment that space a little bit. And you know, I think we've talked about it before, Chris, is that, you know, even if we were really crude and we just segmented retail into 2 sections, to short-term gambling to actual yield hunting, you could segment retail into that, and I think what will happen is that the sophistication of the segmentation of how we categorize retail will change over the next 2 or 3 years. And it's a little bit like if we look at betting, you know, the Betfair, you know, guy who's laying back into the Betfair exchange to the guy that's going in with £10 to Ladbrokes and having a flutter. Retail in the financial sector is segmenting, and you're always going to get the gamblers with tiny accounts, and you're always going to get the guys that are trying to put more in and make a yield come out of that. And at the moment, everyone's lumped into one bracket, and over time, the marketing engine that we all are part of will learn to segment those people out. They're here to stay. There will be some very, very bumpy moments, and there'll be some front page news of some tiers that people have been absolutely ruined. But so be it. You know, you know, this is just a middle class version of what was going on in the streets in the 90s with William Hill and Ladbrokes betting shops. It just needs segmenting.
What do you reckon, Nick? You got any views on the whole retail explosion that we've seen?
Well, yeah, pretty much same as what Adam said. I think that if we get a negative shock that is, not on the market's radar or the retail market's radar, there's going to be a lot of tears. But as a trader, you need to sort of go through that rite of passage before you either quit or you learn from your lesson. So.
We'll wrap it up now, but just quickly, I don't know if you're able to do this because that's not really what we do as traders. We react and but in terms of instinct for the for the year ahead, what kind of instinctively feels like the right trade for or one of the best trades or the best view, should we say, for the remainder of the year? Adam.
I think we're in the aftershock phase of a very big shock. I think sell vol on rallies. I think we'll start to see some stabilization in some of the G20 currencies. The dollar weakens. People are overpricing risk now, and we're entering what I call the churn zone, where the institutions can make some of their money back from the hosing that they took in the sell-off. So that's how I'd play it. Sell vol.
Nick?
Yeah, I think if we don't get a big hit with this second wave business, I think eventually we start getting news coming out bit by bit that one of these 150 vaccine and treatment candidates are making progress, and you want to be positioned for that before it happens. I think short dollar and long FX, long commodity FX, long commodities, long a little bit of EMFX, long a bit of equities all around the world. With rates this low, is you scale into a portfolio like that, come back in 3 years.
Cool.
Yeah.
Unless there's a shock.
Give yourself time. That's the key. I think everyone wants it to all happen like it was happening in February and March. It's like it's not that. That's gone.
Yeah. No, I tend to agree. I mean, I think the short dollar trade's a good one. We're going to wrap it up now. We're going to have half an hour break before we get to the next group of speakers. Just to let you guys know, there will be a recording of this. It will be automatically sent out to people who watch this and also people who haven't been able to watch this one. There will be an email about how you can get in touch with Adam and Nick and their details. So you obviously you can get in touch with them on Twitter as well. But we will make the on how you can get in touch with both speakers if you like what they've got to say and how they viewed the market. And I think it's been a really interesting chat to see two guys who both manage money, both manage clients' money, and have had to share the pressure of trading that in what's been an absolutely crazy few months. So yeah, thanks guys for taking part. And if you want to get in touch with them, there will be an email, or obviously you can get in touch with them via usual channels, LinkedIn, Twitter, and all those kind of factors. So thanks very much, guys.
Cheers, Chris. Thank you very much. Cheers.